are being offered to you when it comes to the buyer's offer and what they're qualifying for, and help you understand to be comfortable with the program and then realize whether it's the right fit for the client and make good decisions and how to accept those offers. Makes sense to me, don't you think?
Sounds good to me.
All right. Okay. Can you give me a sharing screen?
Yep, I gave you sharing privileges. And
Okay, boys and girls.
also, should we tell them that I uploaded on the files folder of KW Shares this presentation? So if they want to follow along or refer to it later, it's there.
Absolutely. And I'm going to be sharing it here too as well so you can recognize what it looks like. So before we start, let's talk about again. We always go back to these three questions when you're prospecting your client. The three quick questions when it comes to their financing or applying for and qualifying for a loan. Real quick, the three question is: do you know what their credit score is? How long have they been employed? And what is the budget for your purchase price and down payment? Because these three very basic questions really determine what kind of loan programs they can possibly get and qualify for. And having answered these questions will drive the rest of the process for the pre-approval. So we'd like to revisit these three questions because everything we talk about in the mortgage world are fingers to these three questions, or they're the downline of these three questions. Okay? Okay. Now
Okay.
let's move on to the meat. That was the barbecue. Oh, it's gonna be one of those days, I'm telling you. Okay, so the purpose of today's call, today's program and webinar or Zoom is there. I have compiled in today's 1 hour. I'm gonna try to get it all as best I can. All the, pretty much not all, but the essential loan programs that you will run into in 2021 and forward. A lot of them went away during COVID. A lot of them came back. Most of them are actually back. You'll be surprised to see some of the programs you'll hear about today if you haven't touched them in a while. But the takeaway for this programs that you're going to learn is, again, what programs may fit your client, your buyer, so that you are aware of these type of conversations and communications when you're dealing with the loan agent and the buyer, or as a lister, you're dealing with offers, same as I said in the beginning. So let's get started. And I want to talk about first something that's gone away back in '07, but it came back 2-3 years ago. They gave it a different name. It's a little different. It's a little bit more conservative as compared to '07. Basically, it's called the non-QM, the non-qualified mortgage. And by the way, guys, a lot of these stuff you might have seen in 2020 in 4 or 5 of my previous mortgage stuff. What I'm doing today is I've taken all of that information in one conversation today, take lots of notes, print this or get this from the download from Kim, because this could be a cheat sheet as you go forward with your clients, buyers, and listing agents, especially, okay? The non-QM essentially is that non-qualified mortgage that does not fit the conventional type of lending because for one main reason, typically, they cannot document their income. Doctors, self-employed people, a lot of those individuals that fall short on their tax returns for good purpose, because obviously they're taking advantage of their tax shelters. And the bottom line is the number that they show does not let them or allow them to qualify for a loan or for a mortgage. So here are some highlights, some general highlights. The one thing that you learned today, yeah, you could do today a loan with just using 1 year of tax returns. Why would that be important? Well, let's just say that whatever reason your borrower started filing only last 1 year, hasn't filed for 2 years, for whatever reason. There could be numerous reasons. Guess what? There's still a chance, right? The best one today that we use and that I've used a lot recently is the 12-month and the 24-month personal and business bank statement programs. Big program right now. In essence, instead of W-2s, pay stubs, and tax returns, we gather up either 12 months of their bank statements, whether it's personal or business, they do have a choice. And we use the deposits every month. The average of that, whether it's a 12-month average or a 24-month average, it becomes their monthly income. Why would that be great? For a self-employed individual that has a lot of cash flow monthly, that would be the best way, right? Versus a W-2 or a business or self-employed income, tax returns. So that one is very, very popular today. It has qualified a lot of buyers recently um, versus doing conventionally. What's the caveat? One, the only thing I'll tell you right now is the rate is typically higher. It's floating in the 5% range versus today's conventional is about 3%. So there's 2%, 2.5% cap. Another good highlight, if you run into a condo that has had problems in the past, has litigation, HOA financials has some kind of problems with it, they're not financially strong, not enough reserves, they become what they call non-warrantable condos. And because they're non-warrantable, they cannot qualify for conventional financing, your typical 30, 15, 20-year fixed rate, right? Well, on the non-QM, they can do so. So something to keep in mind. And then fallouts, boy, we've gotten a few of those lately. One of the best part of the non-QM is if they're going to fall out from a conventional loan because they couldn't qualify, there's probably a good chance that they can qualify for the non-QM. But then guess what, Jojo, do I got to pay for another appraisal? Typically, the non-QM lender, if you look at the bottom line there, they will accept appraisals completed by another institution as long as they complete a transfer letter. I've done that recently. So a conventional loan falls out for whatever reason, non-qualifier, they qualify for the non-QM, we can take this appraisal they've already paid for and move it over, typically. Are there exceptions to that rule? Sure, but more often than not, it will work. So that's the general highlights. Let's get down a little deeper on the non-QM, and we'll spend more time on this on the other programs. By the way, as usual, if you have any questions, hit the chat line. I'm looking at it, I think, and I'll answer your questions. So what I said earlier on the non-QM is typically your stated income and verified assets program. So the driver of this non-QM is there's a lot of down payment required. Typically 20% to get a favorable rate, they want 30% on owner-occupied purchase and rate and term refi. They will do cash out. Won't talk about it today. They can go up to $2 million, some of them up to $3 million in loans. The second qualifier, though, is you must have some leftover money. They call them reserves. After you close your deal, they want you to have minimum 6 months or more of monthly mortgage payments left in the bank. The third qualifier is they want you to have at least minimum 700 FICO. So it may not be for those clients that have low FICO scores, right? It could be, again, for that self-employed individual, the dentist, the doctor, the CPA, the contractor that have great scores but cannot verify their income. And again, we can use alternative documents, which is the bank statements, 12 months or 24 months, or 1 year's of tax returns. There's even a product out there, believe it or not, that they can use called a VOE, a verification of employment only form, no other docs. We won't go into that today, but it is available. So it's a good program to know once you get hit by an objection or a problem that your client buyer cannot qualify conventionally, think non-QM right away. Could the non-QM that Jojo was talking about, could that fit? Could that be an alternative? Or I'm having a fallout. I just recently had a deal with one of our top agents in Calabasas, falling out of one of the deal. We were able to salvage it, put it into a non-QM product. We recorded this morning, actually. So it's a great option to have and to know. Now, some of you might have heard of the ITIN. Let me define. It's an individual tax identification number. It's for those people that are here that do not have an official social security number for a number of reasons, right? They're in the middle of applying for their permanent resident alien status, or they just got here, they have a work sponsorship, and they only have what they call an ITIN number. Now, if they are working here, they've established themselves here, they've actually have a credit score here, but they still don't have their permanent social security status or number, they can still get a loan. And it's what we call the ITIN program. And the caveat or the requirements are 20% down minimum, 700 FICO, and the interest rate starts higher at 6% and up. But it's available. So if you see that, I've actually physically done a couple of that in the last couple of years, maybe 2 or 3, and it works. The challenge is the down payment. FICO is typically there, but if they have it, they can get that program. Many lenders support it. and there's no prepayment penalty, so they can refi that rate. As soon as they get their social security number, they can go and refi into conventional, get that 2-3% current market rates. So far, so good. Any questions? You see any chat questions? Kim? No? Hold on. Can't even unmute you.
No, I don't see any yet.
Okay. I'm going to leave you unmuted, though, in case I have to ask your question.
Okay, I will.
Okay, moving on. Now, a couple more products out there for you to recognize, and these next three also fall in the non-QM category, and they are the asset depletion loans, the DSCR loans, and foreign national. Let me explain. Here's a client that comes to you, self-employed, but tells you, Jojo, I do not show any income at all in my tax returns. Oh, Jesus, that's too bad, Mr. Client. But guess what? I got $3 million in the bank. Well, there we go. There's your answer. By telling me that they have this much assets in the bank, I'm right away, I'm thinking to myself, it's an asset depletion possible loan. And what that is they take the balance. I'm going to give you a very short, simple explanation. They take the balance that they have in the bank, their assets, total assets. They're typically in a few accounts in one bank, maybe a few more, but they take that, they put together a formula to it to arrive at what they think they might earn potentially on interest income on that asset base, based on some kind of hybrid interest rate, based on market hybrid interest rates. They come up with a monthly interest income they can get. And because it's such a high balance, it's typically going to be a high interest monthly income. And that becomes their income that they will use to qualify. A very simple explanation. It's a little more complex than that, ladies and gentlemen. But like I said, they'll take the balance, 3, 4, 5 million, whatever that is, and the income they may be driving, or probably they're already getting, because some people who are retired have assets, retirement assets, they're pulling that income. That's what they will use for income. Combination of both, sure. Big sports players, they use asset depletion, because you have to think they have tremendous amount of money in a bank somewhere from their initial contract signing or on their ongoing income as they've been playing, and they may not be playing at the time when they buy a home, so forth and so on. They may not be able to show all their income, whatever. They can use the asset depletion.
Jojo?
Yes, ma'am.
A question about that. Would it work for people who have a lot of money in the stock market?
Absolutely.
Okay.
Absolutely.
All right.
Now, will it work for people with a lot of money in the refrigerator? No.
Uh-oh.
But absolutely, stock market, credit union, banks, investment accounts, any wirehouses such as Goldman Sachs, Merrill, all those guys, absolutely. Insurance monies, because there's some insurance there that has cash value, whole life, annuities, absolutely.
Okay, good to know. And then before you get too far on this, going back to the last program, would a person need 2 years of work experience in the US, or could it be outside of the US?
It can be outside on that program, the non-QM.
Yeah. Okay.
And also to add, if the assets is outside the country, it's okay as long as it's in a bank outside of the country, in another country, in a foreign country.
As long as it's in a bank. So that you're talking about this program right now,
Yes.
right? Yeah.
Foreign funds is allowed, as long as it's sitting in a bank, not a big bag.
Okay, I'm starting to wonder where you keep your money, in the fridge, in a big bag.
Yeah, thank God I have security alarm in my house.
Uh-huh.
Okay, DSCR loans. This actually, the main purpose of this loan is for people that buy investment property. And then again, they say they have the same challenge. They can't qualify for regularly with income to buy that investment property. Well, guess what? If they meet the parameters of DSCR, the DS stands for debt service. I forgot what CR stands for, but this loan is for primarily, I buy an investment property. I cannot qualify normally to buy it on income tax returns, W-2s, but we know it's an investment. It's going to earn X number of income, and I'm putting down about 20, 30% down payment. They will use that future rent to debt service the mortgage on this rental property so that the buyer can qualify. So instead of using their income to qualify the payment on this new investment property, they will allow to use the future rent, especially if it's a good amount of rent on this investment, to qualify and buy that investment property. So it works real well for investors or people that are looking to buy a second, third, fourth home, and they have large down payment and excellent FICO scores. So remember that, DS, debt service. Last on my list today for the non-QM is foreign national. Jojo, my uncle just got here. He's only been here like a year from the Philippines, but he has 30%. He's established some credit and he wants to buy a house. No problem. Foreign national loan product will suffice. It's again two caveats: at least 30% down payment and 700 FICO scores. And they can buy here. And if their money is partly sitting in another country, that's okay. If it's all here, even better. So it works to really entice a foreign national to be able to buy a property here. Rates are high, yeah, they're going to be in the 6, but it still allows them to purchase the property.
Okay.
So
one more question on the ITIN. When we talked about having money in the bank or stocks, would that apply to this program as well?
Yes, on the ITIN, yes. If the money is here, great. If some of the money is in another country, that's okay as long as it's in a bank.
Okay.
They got to just at least they must have 20% down and 700 FICO. They can fly.
Okay.
Oh, just reminded of another. Okay, moving away from non-QM, ladies and gentlemen, let's talk about some of the things now in. This is I call this the DPA world, the down payment assistance world, or the government loan programs world, because you hear of government loan programs typically as an FHA loan or a VA loan, Veterans Administration Loan. And then some of you, or maybe a good number of you now, since coming to these mortgage stocks, would have heard some of these other programs. So we're recapping this for those of you who have heard. We offer manufactured home loans. Minimum 620 FICO. They can get it in a 5% down or 3.5% down FHA or 100% down VA if they are a vet. And the debt to income ratios are anywhere from 45 to 50. 50% must have a 680 FICO score. However, I get a lot of calls on manufactured homes. The main question I always ask is, are they permanently affixed and built after 1976? That's important. I'm going to share with you guys a flyer. Where are you? Where are you? Innovation. Wait, thought I had it. Excuse me 1 second. Maybe I'm only allowed to share one screen at a time.
You can toggle between 2 screens. Yeah, you're right. Just one at a time, though.
No, I had more flyers that I pulled up, but it doesn't show up on my screen. Okay, that's okay. Let me close out some of these other ones.
If you click share screen again, I think it will give you a prompt to choose what you want to share, your Google or a PDF. Did it do that?
Sorry. Nah, it's okay. It won't come up because for some reason it's limiting the. Never mind. Okay. I can work with it. Okay. So, getting back to manufactured home, I had a flyer for you guys, but I can send it out later. Manufactured home, again, the key question is they have to be permanently affixed, built after 1976. If they have wheels under, then they qualify for a vehicle loan. Jojo, where can I get those if they don't qualify for permanently affixed? Well, there are specialty companies out there today that just specializes on mobile homes, period. And you can Google them, especially even if they have axles or tires under. Some credit unions still do them, and they do them under their vehicle loan program. So credit unions another good source. But if they are permanently affixed, they're considered a single family or anyway, basically they can qualify for a 30-year conventional program, either an FHA, VA, or a conventional 95. Okay, I do have the renovation loans. I want to touch on this for you guys today because this is good for investors. Where
Yep,
are we?
we're getting questions about that.
Renovation. Thank God I can still do that. No, I can't do that either. I do have the renovation. What is going on here in my world? Hold on, guys. I'm having a technical difficulty here. Ah, there. Renovation. There you go, guys. Can you see this? Your guide to renovation loans?
Yes, we can.
Okay, awesome. So, great for investors, right? Because it allows for distressed properties and fixer-uppers. Here's the caveat. Here's the key. As long as you want to keep, you can keep those renovations on within $35,000 or below, as you can see right here. It will fall under the FHA limited 203K rehabilitation loan. And the reason I emphasize that, because that's the maximum number you can get without having to go through a lot of hassles in inspection, escrowing the money, and a lot of paperwork from FHA. They do, FHA 203K is almost as popular as a standard FHA when it comes to doing renovation loans. And again, if you can keep it in $35,000 of repairs, it's quite simple to do. So then you've got also the 203KB rehab that only 5,000 or 10,000. So as you can tell, if you go 35,000 or below, the process becomes simpler and easier. So that's why that's the sweet spot, if you will, on the rehab loan. Will they allow for higher? Yes. The paperwork and underwriting is a lot more stringent. So I say if it's a quick flip and you have some of the money and you just need some additional money, this is great. You're a homeowner that's just buying a second home or your first investment property, this is another good product. If you're very cost effective in renovating a home. And then it's also, let's see, it's also available in the VA product, and there's also this VA Spanish home style renovation loan. But the most often used is the FHA product because that's the most popular, and it's also available with a lot of different lenders out there today. And the underwriting guidelines is very familiar to most lenders. So it's available. We have it on House America Financial. We have a good lender for this program, along with the manufactured home program earlier. So something to think about. If you hear, or forget about an investor, right? A owner-occupied first-time home buyer sees a home, sees that there's some challenges with a home. It's not 100% perfect to them. And typically at that level, the $35,000 amount will suffice in doing some quick aesthetic rehab. Great opportunity. And what will happen is they'll give them a loan for 96.5% of the purchase price because they have to come up with 3.5% of the down payment. And then they'll add a $35,000 into the loan for funding, and they will keep that $35,000 at escrow so that you can use it as you renovate the home until it's done and closed. So I forget about that. First-time home buyers looking at a not so perfect home, but has good bones, good structure, good, and they like it. Here you go, guys. The FHA renovation program, 35,000 or less. Can't use it to buy a Mercedes, Kim. Sorry.
No, but I can use it for when I buy a foreclosure, right?
Sure. Any questions on this?
Yeah, we have quite a few you need to get caught up on.
Okay. Thank God I have time.
Let's see.
It's Pomona.
Okay. How about when Teresa wants to know when they fall between the asset depletion loan and they want to buy an investment property, what happens then?
I don't understand the question. They can qualify for the asset depletion and they want to buy investment property?
I
They
think
can.
when they don't qualify for that.
For the asset depletion?
Yes.
So I guess my next question is, then we would talk to them and figure out what niche could they fit in. I mean, there's not an automatic default. Could they fall in the DSCR program? Could they fall, can they fit in the stated income verified asset program? I'm not quite sure. We would obviously investigate, ask, further interview and then see.
Okay.
I'm not sure if I
And
answered that correctly.
okay, she said yes. I think you answered it. And then also going back to the DSCR loans, do you need the same 2 years job experience at the same job?
Because they're not using your employment income, they don't really care about your job history. What they care about is your assets, how much money you got in the bank for the down payment, and the fact that this home can be rentable. So the answer is no.
Okay. Let's say a first-time investor takes out a loan, they can do an FHA renovation loan program that adds to the original purchase price. They can use this loan to add value, or can they use this loan to add value to their investment property?
I'm not sure what that means. So the first-time home buyer uses the rehab renovation loan to buy the home.
Yes.
Am I on track?
Right. And so he adds to the original purchase price. Then can they use the loan to add value to their investment property? I'm not sure which loan.
I'm not sure either, but let me rephrase the question. If you did the rehab loan on this property, you spent $35,000 additional, there's a good chance that that house will be more value down the road, maybe 6 months or a year, because you rehabbed it or you added all these repairs to the house. So yes, your loan balance will be $35,000 higher, but probably, especially in today's market, the appreciation value of that home will outrun that balance very quickly. I think that was the question.
Okay. Let's just give it a second and see. I know there's a little bit of delay.
No problem. I'm gonna pour myself a little martini. Oh, it's 3 o'clock happy hour somewhere. Woo! It's a candle.
Okay, here we go. Back to that question. Yes, to rehab, get value and rent it monthly.
Excuse me?
Back to the question that you just answered. It would be to rehab and get value and rent it monthly. So I think you answered the question.
Yeah, listen. I think the question is they want to know if they rehab it, and if they rent it, will it rent higher? Well, possibly, compared to like when you first found it, if it really needed repairs, right?
Yeah.
You bought the house and you walked in and there's no carpeting, no walls, no AC, and you put all that in. That would be just a simplified example. Then yeah, you'd be able to rent it. Or you got a house with decent, it's move-in ready, but then you took the $35,000 and you upgraded the bathrooms, the kitchen, the flooring, the windows. Well, yeah, clearly someone will pay more money for that to rent it. The exact science, I don't know. I couldn't tell you exactly because that's a very subjective issue. The market rents will dictate it depending on how great the house is.
Okay. If someone has double the down payment in the bank and good credit, can they do a DSCR with a 3% down payment?
Nope. 3%, they typically want 20 to 30%.
Okay.
On DSCR. These, don't forget, guys, the non-QM loans is there because they rely on the high down payment. 30% is the magic, the sweet spot typically. So that's why they're offsetting the risk of not verifying income, because you've got so much into it, 30%, there's very little chance that you'll walk away from that property.
Yeah, that makes sense. Okay, one more question. Is there a government program that can help first-time buyers with their down payment?
Well, I guess that's a good segue into the next discussion. And we shall talk about, oh, where'd it go? What'd you do with it? Here,
I can take it.
we'll talk about the down payment assistance program. Can you see my screen?
Yes.
Okay. I did a session, a big session on these programs. I think it was last month or a couple months ago. And we're going to revisit it again because it's becoming very prevalent recently for first-time home buyers. I actually have a couple of clients that I'm working with right now with this. First of all, it comes in a couple of formats. Let me explain. Because there are different lenders on the DPA program. There are. Before I go to ours, let me explain the first one. The first type is, it's an FHA loan typically. And if you recall, in an FHA loan, you need to put 3.5% down payment. With the DPA down payment assistance program, that 3.5%, one version of it is they give it to you as a silent second. So you have a first mortgage of 96.5% balance of the purchase price, 3.5% silent second. There's payments on the first mortgage, but there's no payments on this second. That's why it's called silent second. So that's one type of it. And I'm not going to get into the specific details on this in this session, but that silent second, is it due and payable when they sell the house? Yes, but there's never any payments. Interest will accrue. That's one type. The second type, you're getting tired. Where's that, Martini? Is again, FHA, 96.5 of the purchase price of the first mortgage. Then there's 3.5% down payment assistance, but it is also a second, but it's not silent. So that's the second type is, now there's a payment on the first and a small payment on the second, roughly it may be $100 to $300 because that's that low 3.5% down payment. That's typically what you're looking at. That's another version. Now let's talk about our version. We have a great advantage. So getting back to buying that home, 96% down of first mortgage FHA, 3.5% down payment typically, but this time our program, our House America Financial Program, will give it to them as a grant. Free money. Free money. Free, gratis, libre. ¿Te habla español?
Sí.
So that's what happens. Free money. So no silent seconds, no second payments. It's free. The interest rate is higher, yes, in the beginning. But as long after the first 7 months, you can refi it, the whole program, into much lower rate. Today's market will probably, again, appreciation will take over and outrun. And you can get the typical FHA rates of 2.5% to 3%. But that 3.5% is forgiven and forgotten. That's the main difference with ours and all the other ones out in the market. Nothing wrong with those. Nothing wrong. It's just that and they do have their pros and cons. Like their interest rates will be lowered, but they'll have a second mortgage payment. Here, our interest rate is higher, but no second. That $21,000, $30,000 typical down payment is forgiven after 7 months of if you refi it. It's really forgiven, period. If you kept the house, you don't have to pay it back. It's free money. It's a grant. It comes from the state. The qualifications are all pretty much the same on all programs. But here's one more interesting factor. We talked about it today. Our program is designed primarily for not only first-time home buyers, but for all these individuals, first responders, educators, medical personnel, civil servant, military personnel. Jojo, I have a client that wants this, but they've not done any of these things. That's okay. If they've done any volunteer program 1 day of their life or 1 hour of their life right here, we have a workaround. So it's okay. The short answer is it's okay. Obviously, they really market it to these folks, but even if they don't fall in this category, if they've done some kind of non-paid volunteer program, we just have to sign a couple forms and they can also take advantage of this program. And listen, guys, on this program, they get the 3.5% grant, right? They can still get concessions from the seller to pay for the closing costs. See here? So this could be technically 103% loan to value program with pretty much almost zero money from the client other than the appraisal fee, right? So for those of you agents today that are going to the scripts program every morning with Stephanie, Luisa, and whoever else, what's a good script here? Or what's a good tagline? Mr. Buyer, how'd you like to buy a home for no money down except for to pay for the appraisal? What? What kind of martinis is Jojo making you drink?
I think last time you talked about this, someone asked, do you mean if I say that, if I tell them that I volunteer with my son's Boy Scout troop, does that count? And I think you said yes.
Yes. Wink, wink. But if you did, absolutely. Any kind of volunteer, non-paid. We would just have to document it on a form that is required by the state. And yes, they're not, trust me, they're not very strict about it at this time. Can they be in the future? Yes. You know when they become stricter? When the funds are running low on that grant money. And they do run out. Right now, there's plenty.
Okay,
Great
you ready
question.
for your questions?
Oh, there is? Okay.
Yes.
Lord.
Okay, I think you
Let me
already
also
answered.
mine. Go ahead, sorry.
Oh, I think you already answered. It is for first-time home buyers, correct?
It is typically.
Okay.
Wait,
Is there
wait,
minimum?
wait. Yes, but if your client has not owned a home in the last 3 years, guess what they are?
First-time home buyers.
Kim, you're killing it today. You're absolutely. If they've not owned a home in 3 years, they are now considered a first-time home buyer again.
Okay.
Wow.
Let's see.
Free money and first-time home buyer. Oh, geez, this is crazy stuff.
What about a minimum FICO score?
620.
Okay.
I'm fast like that.
Yep. You know your stuff. And then, oh, I think this is going back to the other loan, but if you have never bought a home and you don't have 2 years job experience, but you do have good credit and money in the bank, then can you buy a home with an FHA loan and a cosigner?
Nope. Non-QM only.
Okay. Okay, I think you're caught up for right now.
Where's my Mona questions?
Oh, she's here. That was
Okay.
her question. I just asked you.
All right, no, I haven't heard Mona questions, so I like that challenge every time with Mona. Keep me on my toes. Okay, so that's the DPA program, guys. So far, I've taken you to a non-QM program with stated income, DSCR, foreign national, manufactured homes, asset depletion, renovation loans, DPA. So again, I'm tying this back to the original purpose, giving you loan tools to recognize your client, your buyer, to recognize what type of programs may fit for them in the initial conversation, to make you more aware, to make you more credible, and definitely to give you vernacular as you're talking to people about these things. Great to be as an expert in real estate. Heck, why not add some lending information in your toolbox? And then you're very well-rounded and you can truly provide the amazing client experience. Okay, moving on. Let me go back to my original sheet. Oh, I'm 2:41. I got 20 minutes left. So let's see where I'm at. That's not it. This one. This one. Okay. We went through renovation. We went to down payment. Oh, okay. We went to manufactured home. Okay. So now I want to talk to you guys about this because I've done quite a few of this recently, especially in the last 30 days, and it works. So Jojo, my client, you did a pre-approval for us, and you told me that they can only qualify for the FHA loan, 3.5% down payment, 2.25%, 2.5% interest rate. They love it. We want to make an offer in this condo, but Jojo, guess what? I found out from the listing agent, the condo is not, or the townhouse, or condo, either one, or the PUD, is not FHA approved. What do we do? Boo-hoo. Do we walk away? No. You're going to call me up and say, Jojo, it's not FHA approved. What can we do? We can do an FHA spot approval. So we have that ability to, and basically by definition, this approval process will not approve the whole building. It will only approve for FHA lending the unit that you're trying to buy. So that's why it's called a spot approval. It works. What are the pros? Well, you can use the FHA loan for that one particular unit only. And they can qualify, they can use the FHA loan product, more lenient, allows for lower credit scores, allows for low down payment, allows for higher debt ratios. So great product. Now we can approve that unit as long as, again, the building itself, the HOA management of it is in good order. And what I mean by that is, there's a couple of questions they have to answer, but that they're not being sued, they're not in bankruptcy, they have money in reserves, they're able to maintain the premises, normal things that you would expect out of an HOA, nothing more, nothing less. So we can do that spot approval. The cons, it will add another 10 business days to your escrow. So don't even think about doing 30-day escrows on it. 45-day minimum is the recommended. And it will add about a $300 to $400 cost to the client, because the client not only now will have to pay for the appraisal up front, but has to pay for the spot approval up front. And most of that cost, by the way, that $300 cost for spot approval is being charged by the HOA. Most of it is for a bunch of documentation and paperwork that they're going to provide. So it is available. If the client wants to move forward, typically what I do is I tell the selling agent, can you please make a phone call to the listing agent and tell them that this is what we're willing to do, if they're okay with that, with the offer with that, and ask him a very simple question: how is the health of the HOA? If they say it's awesome, it's in great health, both financially and operationally, excellent. They cannot tell you specifics, they're not gonna know, but I would expect a listing agent to know the overall health of the HOA, because they need to know, they're listing the house, right? Okay, so it's there. It adds a little longer time, but it's done. I've done a few of them. It works, and it's available. Questions there, Kimmy? No?
Nope, but
Okay.
Emilio would like to know the best way for you to meet with him and his client if they want details of these loans and they want to hear it from the pro. I gave him your email address.
Yeah. Amelia, we could do it anytime at the office. You come in there and I come in there. Just let me know what day and time and I'll be in there. I'll probably be there the day of anyways, but yeah, just let me know what time so I'll reserve it. No problem.
Okay.
And guys, back in the day, I used to do a lot of these seminars in front of like quite a few big, 10, 20, 100 people sometimes as an audience doing these kind of learning seminars. We can't do it today, but as soon as that availability comes back, trust you and I, let me know and I'll be there. I'll do it. I'll talk for hours or 30 minutes, whatever, and I'll do all these educational seminars. I used to do VA seminars, FHA seminars, down payment assistance seminars, first-time home buyer seminars, name it. Okay, moving on. Last piece, we have 15 minutes, is I want to some of you have seen this sheet, and I just want to summarize. This is a good sheet to have. I used to call them cheat sheets, because it tells you what are the minimums, what do they have to get these type of loans. And I'll only go over a couple of them, and we already talked about some of them. For example, if you're doing an FHA loan, this sheet tells you they need at least 3.5% down payment. Here are the scores, as low as 620, 660 and up gets them a better rate, better interest rate, and 620, 639 is okay, but they're going to get higher interest rates. What's high? 3.5, 3.7 is still within manageable reason, but that's the caveat. VA loans, no down payment, 620 minimum score. By the way, we have a conventional 97 loan program, guys, 3% down, Some of you are asking, what is the lowest down payment available? This is it, conventional 97. It's different from the FHA. One, it's still only 3% down. It also available at 620 score. The main difference with conventional 97, guys, is two things. One product, one program of it has the income limitation. And we can go over that on a one-on-one basis. That means they can't be making $1 million a year. Well, it's actually a lot lesser than that. But and the second one, the second program has geographical restrictions. You can only use this loan program on certain parts of the county and city. That's why it's not as popular as the FHA, because FHA has no restrictions on income and where they can buy. But 3%, it's there. It may work for your client depending on where they're at in income and where they're looking to buy. Conventional, 5% down. Conventional high balance, 510 to 765. By the way, this number 765 has gone up. I think it's 789 now for 2021. I'll check, but it has gone up, so this needs to be revised. 5% down on high balance. FHA high balance has also gone up now as well, but it's still 3.5. So the definition here is high balance, LA County, Orange County, Santa Barbara County, for the most part, they have higher loan limit balance than like Riverside or San Bernardino. You got to Google it up and you'll see. FHA high balance in LA County versus FHA high balance in Riverside. I think it's 510 or 540,000 max in Riverside, and here it's 780 now, I think, in LA County. So you see the difference? It's market driven, it's government driven, but that's the reason. Last today, non-QM loans, minimum is 20, but I said the sweet spot is 30%, but you can do 20, 680 minimum, 700 would be better. Jumbo loan program, 790,000 and high and up, will always require a minimum of 20%. And look, 780 credit score is the sweet spot. So if you're looking to sell $1 million homes, make sure that they have at least 200,000 plus for down payment, and that they have at least 780 scores, because the people in that market are very competitive in looking for interest rates. But the caveat for them is they got to have really good scores, 780 and high. Most of them will, but just know that in the back of your head. So when you're talking to those clients, that market segment, you know what you're up against or what you need to be looking for those type of clients. That's it today, ladies and gentlemen. Looks like I'm about 10 minutes early. Any Q&A? Let me shake up my martini shaker here real quick. Kim, you're muting yourself. Stop muting yourself.
Sorry, there was fire trucks going by. I didn't want to bother you with that.
Those are just my old homies. When I used to work at the fire department, they were checking up on me. Don't worry about it.
Okay. Do you have some of those previous seminars recorded anywhere on the VH or the FHA? Well, we have some on our YouTube channel, some of the classes you've done.
Yeah, I have. The ones I only have for you guys that are recorded are the ones that Kimmy recorded for me, that is on YouTube and KW's forward shares. And I think 4 or 5. And a lot of them were based on Mortgage 101, the full caveat or the full segments of Mortgage 101, a realtor's tool chest. There was some down payment assistance and FHA in there and VA, I think, and that's it. But it's not the full things that I do typically. The short answer is no, I do not. I don't have it recorded. Should have probably, but.
Well, this will be recorded, and the last one that you did that focused on all the new loans. I can't remember the guest that you had on, but that one also is recorded. Do you know which one I mean?
Yeah, the one with Lee when we actually took a deep dive in the DPA program. That's a good one, guys. We talked about the down payment assistance program. Kim has that one recorded. I had a special guest, the actual vendor or the account rep for the DPA program, and he went through some really good details, even better than I. Mm-hmm. Sometimes that happens, but not rarely.
Yeah, so that one's on our Forward Training YouTube channel. If you just search Forward Training, you'll see the channel there. So I think that's all I see for right now.
Woohoo! Happy hour starts early. Mona, nothing? Oh, Upset.
Mona asked, is 97 okay for someone who just started making 100 to 250K a year?
So it's probably a little high, Mona, because what I've seen, they call it, they're looking for the median income per county that they're buying at. Like for LA County, the median income was 68 to 70,000. So, and the problem, it's a double-sided coin, right? At 70,000, you cannot, double-edged sword. See? Double-edged sword, because at 70,000, it's hard to qualify for a home in LA County. But that's why this 97 is not always, it's not a very popular program because of those limitations. But the short answer is that income, I would just probably say, let's come up with the other 0.5% more and put them in the FHA so they can really qualify.
Okay.
Oh, by the way, on the DPA program, guys, there's no income limits. There's only loan limits that are the same FHA loan limits for whatever county you're buying. Another good benefit of the DPA. So that might be a good program for your people, Mona.
Okay. Well, I think you covered everything, Jojo.
I did?
Yep.
Woohoo! Wednesday Warrior. Well, as always, love seeing you guys, even though I don't see you. Thanks for coming. Thanks for enjoying the Jojo YouTube mortgage talk. And
thank you as always, Jojo.
I'll see you again in 3 Thursdays from today. I'll have another class on a different topic. I don't know what it is yet. I'm going to think. And for now, hasta luego.
Thank you, Jojo.
Thank you. How do I get rid of